Most business owners keep their eyes on profit. That makes sense. After all, profit tells you whether your business is making money. But here's something that catches people out. A business can be profitable on paper and still experience serious financial stress. Some profitable businesses even fail because they run out of cash. That's why business valuers don't just look at profit. They pay close attention to cash flow. Let's look at why cash flow matters, what valuers look for, and how better cash flow can boost your business value. A lot of business owners think profit and cash flow are the same thing. They're not the same. Profit measures how much money your business has earned after expenses. Cash flow is about the money actually coming in and going out of your bank account. Let's say your business completes a $100,000 project and invoices the customer. From an accounting perspective, that income may be recognized immediately. Your profit increases. But if the customer takes 90 days to pay, that cash isn't there to cover wages, supplies, rent, or loan payments. The business looks profitable, but the cash hasn't arrived. That's why profit tells one story and cash flow tells another. Valuers look at both. When a valuer looks at a business, they're usually after one key thing. How much future benefit can this business generate? At the end of the day, business value is about future expectations. Investors and buyers aren't buying last year's profit. They're buying the business's ability to generate cash in the future. That's why cash flow is so important. Strong cash flow shows the business isn't just making sales. It's turning that revenue into real cash. Cash you can use to grow. Cash to keep things running. And cash that can reward owners. The more confident someone is about future cash flow, the higher the business value can be. One of the first things a valuer checks is whether the business consistently brings in cash. Consistency is key. A business with strong, steady cash flow year after year is seen as less risky than one with unpredictable cash flow. Picture two businesses. Both make about the same profit each year. One always turns that profit into cash. The other often runs short on cash. The business with reliable cash flow is usually the more attractive investment. Predictable cash flow builds confidence, and confidence helps support value. Growth is great, but it usually needs cash. Hiring new employees, purchasing equipment, increasing stock levels, expanding into new markets, launching new products, all of these things require funding. A business with good cash flow can often fund growth from within. If cash flow is weak, the business might need to borrow or look for outside investors. Valuers want to see if a business can support its growth plans, because sustainable growth is always a plus. Working capital is another thing valuers look at closely. Working capital is the money you have to cover day-to-day bills. This covers things like managing stock, paying suppliers, covering wages, and keeping the business running. If a business is always struggling to pay its bills, buyers and investors see more risk. But if there's enough working capital, it shows stability and flexibility. That stability can help boost business value. Valuers also want to know if earnings are sustainable. A business might show a strong profit this year, but was that from normal business activity? Or was it a one-off? Strong cash flow over time shows earnings are real, repeatable, and backed by business performance. A business with regular customers, steady revenue, and reliable cash flow usually gets a stronger valuation than one that relies on the odd big sale. Remember, buyers are looking at future performance, not just one-off results from the past. The good news? You can usually improve cash flow with a few proactive steps. Here are some common areas to review. Reducing debtor days and collecting payments sooner. Reviewing inventory levels to avoid unnecessary stock holding. Managing supplier payment terms effectively. Improving forecasting and cash flow monitoring. Examining pricing strategies and profit margins. Reducing inefficiencies throughout the business. Even small improvements in cash flow can make your business more stable and valuable over time. Profit is an important measure of success, but it's only part of the story. Cash flow shows how well your business brings in and manages the money needed to run, grow, and create value. That's why valuers look so closely at cash generation, working capital, growth potential, and sustainability. Understanding your cash flow isn't just about avoiding stress. It's about knowing the strength, stability, and long-term value of your business. If you want to know what drives business value or where you can improve, talking to a business advisor is a great first step.